If you are within 3 years of retiring right now, I need you to stop whatever you're doing and think about one question. Do you know what your Social Security check is going to be on the first day you claim it? Not approximately, not what you think it might be, the exact number. The number that will be locked in permanently from that day forward and will never go back up regardless of what happens in the economy, regardless of what Congress does, regardless of how long you live. Most pre-retirees within 3 years of retirement cannot answer that question with a specific number. They know roughly what they expect. They have a general plan. Claim at 67 because that is the full retirement age, or claim early because why wait? But here is what almost none of them have done. They have never run the number that connects their Social Security claiming age to their IRA, their tax bracket, their required minimum distribution starting at 73, and their Medicare premiums. They have never seen those four systems modeled together. They have seen each one separately maybe, but never together, never as one connected picture. And that picture is the only thing that tells you the real cost of your Social Security decision. Not the break-even calculation, not the simple comparison of monthly checks, the full picture across all four systems across 25 years of retirement. I have had more conversations with pre-retirees in the past year about this specific topic than almost anything else. And the pattern is always the same. Someone is 6 months or 1 year away from retirement. They have made their Social Security decision. They feel confident about it. And then I show them the integrated projection, and something in their face changes because for the first time they are seeing what that decision actually cost them. Not the monthly check amount, the full cost across every tax return they will file for the rest of their life. This video is for anyone who is retiring in the next 3 years and has a traditional IRA. If that is you, what you're about to see may be the most important 30 minutes of your retirement planning. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I'm going to show you exactly what the 3 years before retirement look like from a tax and income planning perspective. Not from an investment perspective, not from a budgeting perspective, from the perspective of the one decision that defines your Social Security income, your IRA trajectory, your RMD burden, and your Medicare premiums for the rest of your life. And I'm going to show you why the 3 years before you retire are the most valuable planning window you will ever have, and why most people waste every single year of them. Let me start with the numbers that make this concrete. For anyone born in 1960 or later, the full retirement age for Social Security is 67. That is confirmed by the Social Security Administration. Claiming at 62 instead of 67 triggers a permanent reduction of approximately 30%. Waiting from 67 to 70 earns delayed retirement credits of 8% per year, confirmed by the Social Security Administration, for a total permanent increase of 24% above the full retirement age amount. What those percentages mean in real dollars. If your full retirement age benefit is $2,300 per month, claiming at 62 gives you approximately $1,110 per month. That is the number locked in permanently. Claiming at 67 gives you the full $2,300. Claiming at 70 gives you approximately $2,152 per month. The gap between claiming at 62 and claiming at 70 is approximately $1,042 every single month for the rest of your life. Indexed to inflation through annual cost of living adjustments. Over 20 years, that gap represents approximately $298,000 in additional lifetime income, not counting inflation adjustments that make it larger every year. That is the number that most break-even calculations ignore. The fact that the COLA applies to a larger base when you delay, so the gap between early claiming and late claiming widens every single year you are alive. But the Social Security benefit amount is not the only thing affected by when you claim. And this is where the 3 years before retirement become critically important. When you retire but have not yet claimed Social Security, you enter what financial planners call the gap years. Huh? Your W-2 income has stopped. Your employer is no longer withholding taxes automatically from every paycheck. Social Security has not yet started. Your required minimum distributions have not yet begun because you are under age 73. For most pre-retirees with meaningful traditional IRA balances, this gap period represents the lowest taxable income they will have for the rest of their retirement, and most of them do nothing with it. The gap years are the Roth conversion window, a period when you can move money from a traditional IRA to a Roth IRA at lower tax rates than you will face once Social Security income, required minimum distributions, and potentially pension income all stack on top of each other simultaneously. Here is what the tax bracket opportunity looks like in 2026. A single filer in the gap. Years with no wages, no Social Security, and no RMDs has a standard deduction of $1,600 with the additional senior deduction of $250 for those 65 and older, and the senior bonus deduction of $6,000 under the One Big Beautiful Bill Act. For those who qualify, a single filer over 65 can have approximately $2,450 in deductions before a dollar of taxable income is calculated. The 12% federal bracket runs through approximately $40,300 of taxable income. That means a single filer in the gap years can convert approximately $71,450 from a traditional IRA to a Roth at 12% or below. For a married couple, both over 65 in the gap years, the combined deductions stack to approximately $47,500. That is the 32,200 standard deduction plus $3,300 from the existing age, 65 additional deduction plus $12,000 from the senior bonus deduction. The 12% bracket runs through approximately $9,300 of taxable income. That means a married couple in the gap years can convert up to approximately $140,800 from a traditional IRA to Roth at 12% federal rates. Every dollar converted in those years at 12% federal rates is a dollar that will never generate a forced required minimum distribution. Every dollar converted is a dollar that will never push Social Security income into a higher taxable tier. Every dollar converted is a dollar that your heirs may eventually inherit tax-free instead of paying income tax under the 10-year inherited IRA rule. And here's the critical timing point that most people miss. If you're retiring in the next 3 years, your gap window is opening right now, not when you retire. Right now, you can start modeling how many gap years you will have, what your income will look like in each of those years, and how much bracket space will be available for conversions each year. A pre-retiree who plans the conversion strategy 2 years before retirement can sequence the first conversions in the calendar year they retire when their earned income is partial year and the bracket space is substantial. A pre-retiree who discovers this concept at age 72, 1 year before required minimum distributions begin, has missed the entire window. The brackets are full. The RMDs are determined by the traditional IRA balance that was never reduced. The Social Security taxability is set by the combined income level that was never managed. If the math I just described is making you think about your own retirement timeline in a way you have not before, hit the like button right now and share this with anyone you know who is within 3 years of retiring and has a traditional IRA. Subscribe and turn on the bell. Now let me walk through the 4 systems that interact with the Social Security decision and show you why they must be modeled together. System 1 is the Social Security benefit amount and the COLA base. When you claim Social Security, you lock in a base benefit. Every future cost of living adjustment is applied to that base. The 2026 COLA was 2.8%. A retiree with a base benefit of $2,952 per month who claims at 70 receives a cost of living adjustment applied to a larger base than the retiree who claimed at 67 with $2,300. Each year, the same COLA percentage produces a larger dollar increase for the delayed claimer because the percentage is applied to a higher starting number. Over 10, 15, and 20 years, those compounding differences mean the gap between the 2 checks is wider every single year. The delayed claimer does not just receive more money in the first month. The advantage grows continuously for as long as both retirees are alive. Before System 2, I want to address one specific trap that catches pre-retirees who plan to work part-time after leaving their main job. If you claim Social Security before your full retirement age of 67 and you earn wages above the earnings test limit, the Social Security Administration reduces your benefit by $1 for every $2 you earn above $24,480 in 2026. In the year you reach your full retirement age, the reduction is gentler. $1 for every $3 above 65,160. Once you reach full retirement age, the earnings test disappears entirely. Here's why this matters for pre-retirees planning part-time work. A 63-year-old who retires from their main job claims Social Security immediately and then does consulting work earning $40,000 per year will have their benefit reduced by approximately $7,160 that year. Half the difference between $40,000 and $24,180. The withheld benefits are eventually recredited when you reach full retirement age, but the crediting happens gradually over many years and is not dollar for dollar in the short term. The cleaner strategy for anyone planning part-time work in their early retirement years is to delay claiming Social Security until the earnings test no longer applies. Use the gap years for Roth conversions on the bracket space created by the lower income and claim, at the age that maximizes the long-term benefit given both the earnings history and the tax interaction with the IRA. System 2 is the traditional IRA and the Roth conversion window. The pre-retiree with a $550,000 traditional IRA who retires at 66 and claims Social Security at 70 has 4 gap years. If they convert $80,000 per year from the traditional IRA to Roth during those 4 years, they move $320,000 out of the traditional IRA at relatively low tax rates. Their traditional IRA at age 73, when required minimum distributions begin, is meaningfully smaller. Their RMDs are meaningfully lower. Their taxable income in their 70s, 80s, and 90s is lower because a large portion of their retirement assets now sits in a Roth that generates 0 required distributions. System 3 is the Social Security taxability interaction. The IRS calculates your combined income for Social Security taxation as your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefits. For single filers, once combined income exceeds $34,000, up to 85% of your Social Security benefit is federally taxable ordinary income. For married couples filing jointly, the upper threshold is $44,000. A retiree who claims Social Security at 62 and simultaneously draws from a large traditional IRA has combined income that almost certainly puts 85% of their Social Security into the taxable range from the first year. A retiree who delayed Social Security to 70 and used the gap years to reduce their traditional IRA through Roth conversions arrives at age 70 with a higher Social Security benefit, but a smaller IRA and a Roth balance that generates 0 combined income. Strategic use of the gap years reduces the portion of Social Security that is taxable, potentially saving thousands of dollars per year in federal taxes on income the retiree cannot control. Before System 4, I want to address the dimension of the Social Security decision that married pre-retirees most consistently underestimate. For a married couple, the higher earner's Social Security benefit becomes the survivor benefit when one spouse dies. When one spouse passes away, the surviving spouse keeps the higher of the 2 benefits permanently. The lower benefit stops. Only the higher one continues. This means the higher earner's decision about when to claim Social Security is not just a personal income decision. It is the income floor that the surviving spouse will live on potentially for decades after the other spouse dies. Consider a married couple where the higher earner has a full retirement age benefit of $2,500 per month, and the lower earner has a benefit of $2,500 per month. If the higher earner claims at 62 and locks in a 30% reduction, their benefit is $1,150 per month. When the higher earner dies, the survivor keeps $1,150. If instead the higher earner delays to 70, their benefit is $3,100 per month. When the higher earner dies, the survivor keeps $3,100, a difference of $1,150 every single month for the rest of the survivor's life. A surviving spouse who lives 15 years after the higher earner's death receives $243,000 more lifetime income if the higher earner delayed to 70 versus claiming at 62. The decision that seemed personal was actually the most important financial protection the higher earner could provide for their spouse. For pre-retirees who were married, modeling the survivor scenario is not optional. It is the most emotionally and financially important part of the Social Security decision, and it is almost never shown in the simple break-even calculation. System 4 is Medicare A and the 2-year look-back. Medicare Part B premiums in 2026 are $22.90 per month at the standard level. The first IRMAA search charge tier begins at $19,000 in modified adjusted gross income for single filers and $18,000 for married couples filing jointly. At those thresholds, the premium jumps to $410 per month. The surcharge is determined by your income from 2 years prior. A pre-retiree who does large Roth conversions during the gap years must be careful that conversion amounts do not push modified adjusted gross income above the IRMA threshold 2 years before they go on Medicare. Conversely, a pre-retire who does no conversions and arrives at age 73 with large required minimum distributions may find that the mandatory distributions push them into ARMA, a territory permanently. Paying Medicare surge charges every year for the rest of their retirement on income they cannot reduce. Before the checklist, I want to address the most common objection I hear when I explain this framework to pre-retirees. The objection is this: I cannot afford to delay Social Security because I will not have enough income to live on during the gap years without it. This is a real constraint for some people, and I want to address it honestly. For a pre-retiree who genuinely does not have sufficient savings to fund living expenses during a gap period, delaying Social Security creates a real financial hardship, and claiming earlier may be the correct decision regardless of the long-term math. But the title of this video says Traditional IRA. If you have a traditional IRA with a meaningful balance, that IRA is the bridge asset that makes the strategy work. You withdraw what you need from the IRA to cover living expenses during the gap years. You also convert an additional amount from the IRA to Roth each year. The amount that fills your available bracket space. The IRA funds both your living expenses and your conversion strategy simultaneously. The pre-retiree who has $300,000 in a traditional IRA and retires at 66 has enough asset base to fund 4 years of modest living expenses from the IRA while also doing meaningful Roth conversions each year. They do not need Social Security to survive the gap. They need to plan the IRA withdrawals carefully so they serve both purposes. The second objection I hear is, what about Social Security solvency? What if Social Security cuts benefits before I reach 70? The Social Security Trust Fund is projected to face a shortfall in the early to mid-2030s under current law. At that point, without congressional action, the program could pay approximately 79% of scheduled benefits. Even a proportional reduction would not eliminate the advantage of delaying because it applies equally to all claimants. A retiree with a larger base from delaying to 70 still receives more after proportional cut than one who locked in a 30% reduction at 62. And a retiree who used the gap years to build a substantial Roth IRA is not dependent on Social Security as their only income source. The Roth provides tax-free income that does not generate the combined income that makes the Social Security taxation problem worse. Here is your pre-retirement action checklist. First, go to ssa.gov right now and log in or create your My Social Security account. Download your statement. Find your projected monthly benefit at age 62, 67, and 70. These are your starting numbers. The difference between the age 67 number and the age 70 number tells you exactly how much guaranteed permanent income you can earn by delaying 3 additional years. Second, calculate your gap years. Count from your planned retirement date to age 70. That is your Roth conversion window. If you plan to retire at 64, you have 6 gap years. If you retire at 66, you have 4. If you retire at 68, you have 2. Each year in that window is a year of bracket space that closes permanently when RMDs begin at 73. Third, estimate the bracket space available each year. Take your total deductions, standard deduction, any applicable senior deductions, any other adjustments, and subtract them from the top of the 12% bracket. What remains is the amount you can convert each year at 12% or below for most pre-retirees with no pension and no other significant income sources. This number is substantial. Fourth project, what your required minimum distributions will look like at age 73 under two scenarios. Scenario 1, no Roth conversions during the gap years, and the traditional IRA grows until RMDs begin. Scenario 2, strategic conversions reduce the traditional IRA balance significantly before RMDs begin. The difference in annual forced taxable income between those two scenarios is the actual cost of not using the gap years. Fifth, model the Social Security taxability in both scenarios at age 73. In Scenario 1 with larger RMDs, what percentage of Social Security is taxable? In Scenario 2 with smaller RMDs and a Roth balance generating zero combined income, what percentage is taxable? The annual tax saving on Social Security income alone can be substantial when the combined income is meaningfully lower. Sixth, check the RMA threshold in each scenario. Does either scenario push modified adjusted gross income above $19,000 for single filers or $218,000 for married couples? If Scenario 1 does and Scenario 2 does not, the saving in Medicare premiums is an additional benefit of the conversion strategy before David's conclusion. One more planning layer that is specifically relevant for the years 2025 through 2028. The One Big Beautiful Bill Act created a temporary senior bonus deduction of $6,000 per person for taxpayers age 65 and older. For a married couple, both over 65, the deduction is $12,000 combined. The deduction is available whether you itemize or take the standard deduction. It phases out for single filers with modified adjusted gross income above $75,000 and for married couples above $150,000. It is available through tax year 2028 only. For pre-retirees planning gap, year Roth conversions, this deduction creates additional bracket space. A married couple both over 65 in 2026 can stack the standard deduction of $32,200. The existing age 65 additional deduction of $300 for both spouses and the senior bonus deduction of $12,000. A total of $47,500 in deductions before a dollar of taxable income is calculated. That is $47,500 worth of IRA balance that can be converted to Roth before the 12% bracket even begins. The senior bonus deduction expiring after 2028 means that for pre-retirees who are 65 or older right now, the next 3 years offer more conversion capacity at low rates than any 3-year window that will follow. A pre-retiree who turns 65 in 2026 and plans to retire in 2028 has a window where the combined deductions are at their maximum, and that window closes permanently in tax year 2028. Now let me show you what the integrated projection actually looks like with specific numbers. So this is not abstract. Take a pre-retire who is 64 years old, planning to retire at 66 with a traditional IRA of $550,000, full retirement age benefit of $2,300 per month. 3 possible claiming ages, 62, 67, and 70. At 62, the permanent monthly benefit is approximately $1,810. At 67, it is $2,300. At 70, it is approximately $2,852. In the scenario where they claim at 62 and draw from the traditional IRA for living expenses with no Roth conversions, their combined income at age 73 will be relatively high because the IRA has not been reduced through conversions. And the RMDs are larger. The lower Social Security benefit plus larger RMDs pushes combined income above the $34,000 threshold, where 85% of Social Security becomes taxable. They are paying tax on a smaller benefit at a rate that affects the most dollars. In the scenario where they retire at 66, do 4 years of strategic Roth conversions at the 12% bracket, and claim Social Security at 70, the picture at age 73 is different in every dimension. Higher Social Security benefit, smaller traditional IRA, lower required minimum distributions, Roth balance generating zero combined income. The combination keeps combined income lower less, Social Security is taxable. Medicare premiums stay at the standard rate instead of the IRMA surcharge level. The tax advantage of Scenario 3 over Scenario 1 projected across 25 years is substantial. Not because of one magic move, because four systems that were each working against the retiree in Scenario 1 are all working for the retiree in Scenario 3. That is the picture most pre-retirees have never seen, and the 3 years before retirement are the only window left to change which scenario they end up in. The 3 years before retirement are not a waiting period. They are the only window you will ever have to shape the financial systems that will define your retirement income for the rest of your life. The Social Security decision, the Roth conversion opportunity, the RMD trajectory, the Medicare premium exposure, all of them are set in motion by the choices you make in this window. Once you retire and claim, the Social Security decision is permanent. Once RMDs begin at 73, the IRS sets the minimum income you must take, whether you want it or not. The window does not reopen. There's one final thing I want to leave you with. The Social Security Administration does not notify you when your gap window opens. The IRS does not send you a letter when your bracket space is at its maximum. Your IRA custodian does not flag the years when Roth conversions are most efficient. The Medicare system does not warn you when your projected RMDs will push you into May territory in 2 years. All four of these systems run on their own timelines. None of them wait for you to be ready. None of them remind you that the optimal planning window is narrowing. The entire burden of connecting them and acting within the window before it closes sits entirely with you. The pre-retirees who understand this framework and act on it in the 3 years before retirement arrive at age 70 in a fundamentally different financial position than those who do not. Not because they earned more during their careers, not because they got lucky with their investments, because they understood that the 3 years before retirement are not a waiting room. They are the last chance to shape the systems that will run automatically for the rest of their lives. David and Charlotte understood that 2 years before his retirement date. If you are watching this video, you still have time too. If this video showed you a connection between your retirement timing and your IRA that you had not modeled before, hit the like button right now and share this with anyone you know who is within 3 years of retiring. Tell me in the comments exactly where you are right now. How many years away from retirement are you? Have you run the integrated Social Security projection yet? Or are you still working from the simple break-even? Do you have a traditional IRA, and have you started thinking about the gap years? Share your situation, your age, your timeline, your questions. I read every single comment. The most specific situations become future videos. And if your question is one that thousands of other pre-retirees are asking, I will make a video that answers it directly. Subscribe this channel for more valuable updates.